Right, so I'm Emily Jones. I'm an associate professor here at the Blavatnik School of Government. And it is my honour and pleasure to introduce Governor Mario Marcel, who's here with us for the next hour. And we're very grateful you've taken time out of your schedule to come and be with us. Who's going to speak to the important topic of getting rules into policymakers' hands, a review of rules-based macro policy. As you probably know, the governor has a very distinguished career. He became the governor of the central bank in, my dates right now, 2016, December. Right? So in December 2016. But following a very long career, which has involved time at the World Bank, the OECD, the Inter-American Development Bank, and of course in Chile, we were just discussing heading up the Pension Reform Commission. So while the governor will speak very much to the macroeconomic question at hand, he's also generously offered to answer any questions more generally about being a policymaker and other aspects of his career. And you'll present for sort of half an hour or so, and then we'll open up for questions and answers. So, Governor, the floor is yours.
Okay, thank you very much. Can I use the podium?
Please do,
so that
yeah.
I can turn the pages?
Yeah.
Okay, well, thank you very much to the Blavatnik School of Government for inviting me. Thank you very much, Emily, for this for this introduction. I'm visiting the UK for a couple of days, and I think it's great to have the opportunity to meet you to discuss these issues of policy rules, macro policy rules, that have become very important in a number of countries, including my own. Macro policy rules come from, essentially emerge from a very deep discussion in economics in the 1970s, where the approach of rational expectations took a very important role. Up until then, there was many macro policy models essentially assumed some degree of stickiness or fixedness of expectations from the public. So by surprising markets, you could achieve a number of things. But all this changed in the 1970s with Lucas and Kydland Prescott that challenged this notion. And then they opened the door for a new way of thinking on public policy. If you think of monetary policy, I think that you can see a great contrast, a big contrast between the approach of a Fed chairman like Paul Volcker that praised himself for surprising markets, towards what we see these days, where central banks actually want to guide expectations and issue a lot of policy guidance to make sure that markets and the public understand what they're doing. So let's take a look at that, especially because when the rational expectations approach emerged, monetary policy was one of the favorite subjects where this approach would be applied. So when the first papers on rational expectations appeared, the natural example that they were tailored to was monetary policy. A strong approach of Keynesian economics up until then was this notion of the Phillips Curve, whereby you had the possibility, or central banks had the possibility of choosing a combination of unemployment and inflation. If they wanted to bring unemployment down, they could do that to the extent that they were prepared to afford a higher inflation. But in the late 60s, it was challenged by Milton Friedman, that basically argued that you couldn't get, if you wanted to reduce unemployment on the basis of high inflation, eventually economic agents would adapt to that, would move faster in terms of adapting prices, and then you would end up with even higher inflation and no major progress on unemployment. So from there was the approach that evolved was the notion that you could eventually achieve or you could eventually have a short-term inflation that was related to frictions in the economy, but long-term inflation depended on issues that were more structural. So this is the basis for what we currently know as monetary policy rules. If prices were somewhat sticky in the short run and fully flexible in the long run, then you could think of monetary policy as a short-run stabilization tool, but where rules needed to replicate the optimal thing to do, that are easy to communicate, easy to implement, as long as there is a mechanism that ensures that it is credible. So basically what they wanted to do with policy rules is to picture the way that they expected, that central banks expected the economy to behave, and then you set up the rules that are consistent with that. To do this, as I just mentioned, the credibility of the central bank's policy is the key to its ability to act as a stabilization tool. In the decades following the 1970s discussion, central banks made great efforts at obtaining and sustaining credibility. These efforts were rewarded by long periods of low tamed inflation, with rules as a central element to this task. Central bank independence has provided the right institutional setup to generate this kind of results, to the extent that it's able to detach the management of monetary policy from budgetary needs and insulate them from the political cycle. In the last 30 years, many central banks around the world adopted or translated these findings into what we call inflation targeting regimes. An inflation targeting regime is one in which there is an explicit numerical target for the inflation rate. That could be a range, a point target, or both. Under this regime, the conduct of monetary policy is then completely oriented towards the fulfillment of the inflation target. To provide further credibility to this regime, a number of institutional arrangements accompany in varying degrees the quantitative rule, such as central bank independence, transparency, publication of inflation and activity forecasts, accountability measures, etc. Actually, I think that today Governor Carney of the Bank of England is giving testimony to Parliament on the latest monetary policy, or the inflation report, as it is called in the UK. Inflation targeting has been highly successful in providing a reliable nominal anchor to the economy, and by this means in anchoring agents' expectations. At the beginning of the current decade, there were 27 countries in the world that had successfully adopted inflation targeting regime, of which 9 were industrialized, 18 were emerging and developing, and if members of the Eurozone and some latecomers are added to this list, the number of inflation targeting countries is close to 50. So you can see in this figure here that there are a number of, there is a mix of emerging and advanced countries that have adopted these regimes, and where the setting of the inflation target is usually with the central bank or shared with government. But the central banks are in charge of implementing that target, even if it's even if it's fixed by the government or in conjunction with the central government. So this group of inflation targeting countries is very diverse, which suggests that this regime may be robust to differences in the degree of development, to political regimes or institutional setups. But one common feature for many of these countries is to have an independent central bank that is in charge of this policy. So for an inflation targeting regime to work, it is not sufficient to announce the target and expect that everyone will believe in it and expectations will magically coordinate around such a number. Indeed, the right institutional setup is, as if no more important as the target itself. This has to do with the announced rule being credible, and for it to be credible, it has to be easy to understand, stable, and its compliance has to be easy to monitor. I mentioned central bank independence. This is almost always chosen in an attempt to decouple the conduct of monetary policy from the political cycle. And this mandate of price stability is usually written into the central bank's law. Moreover, the quantitative target itself is openly communicated to the public. In addition to this, central banks need to be very effective in communicating their policies, justifying them, providing means to monitor their effectiveness, and explaining the reasons behind the possible occasional deviations from target with the sole objective of anchoring expectations. Inflation targeting central banks evaluate economic conditions and forecast variables of interest for the decision-making process using a suite of econometric and theory-based economic models. They usually collect data on a wider range of macroeconomic and financial variables. They monitor agents' expectations through financial instruments like surveys. They produce reports in which they describe the current economic situation, the outlook for the near future, and the main risks the economy faces. So this is very much what you would find in an inflation report like the one that Governor Carney is giving testimony on. In our case, in the case of Chile, it's called the Monetary Policy Report. Transparency in communication is key, and there are different views and styles about how much and in what way information is revealed to the public. The common denominator, though, is that a reasonably high degree of transparency is expected from an inflation targeting central bank. So, but one key question here is whether having an inflation target, having an inflation rule, mean that the central bank has to abide by this rule at all times and under any circumstances and refrain from conducting any type of discretionary policy. In actual practice, that is not the case. There are a number of countries that make exceptions to these rules depending on the economic environment, on whether they're facing some kind of shock. And in the case of this figure here, we portrayed in the case of Chile how much changing the exchange rate regime from a fixed exchange rate into a floating range that coincides with the era of inflation targeting in the central bank still opened the room allowed for interventions at certain critical junctures in the evolution of the economy. So those would be kind of exceptions to this rule because you allow the central bank to intervene because of some disturbance on the exchange rate that may cause some harm to the economy or may be originated from speculation that you want to avoid. So exceptions to the rule may happen in two circumstances. First, monthly inflation measures are likely to include a number of short-term disturbances, measurement errors, high-frequency noise, idiosyncratic shocks in certain markets, short-term cross-cutting pressures like the ones coming from the exchange rate. So due to this reason, most inflation targeting regimes focus on medium-term forward-looking inflation, sometimes approached as core inflation and core inflation measures that exclude volatile items, and more generally by medium-term forecasting models that provide a full picture of how the economy is evolving, that integrate different moving pieces in the local economy. Secondly, exceptions have to do with the dual mandate that a number of central banks have to ensure price stability and economic growth or low unemployment or economic prosperity more in general. So this last element provides a good enough reason for which central banks may choose to depart from price inflation targeting so that you can achieve some of these additional objectives as long as the price stability objective is not compromised. So discretionary measures may be used more sporadically, but of course the more you use them, the riskier it is that you may end up giving up the policy rule as such. So central banks need to be cautious on how much they resort to these exceptions. Now, in the case of emerging economies, a main problem when facing to implement an inflation targeting regime is the credibility and trust that central banks have from the public, because anchoring expectations is essentially for this regime to work. To the extent that expectations are sufficiently anchored to the inflation target, all economic agents will be operating in a functional way to achieving this target. If that doesn't happen, because the credibility of the central bank is low, then it will be an uphill battle to get there. So in the case of Chile, I think it's an interesting example because Chile suffered from double-digit inflation for nearly 30 years. There were some theories on inflation in developing countries that actually emerged from this experience in Chile, but that changed a lot in the early 1990s. At that time, inflation moved from 25% per year in 89 to about 7% by 1994, and then further down, close to 3% by the late 1990s. This happened in a context where the central bank was a completely independent institution since 1989. To ensure independence from the budgetary needs of the finance ministry, the central bank cannot by law trade in treasury bonds, they cannot give loans to the government. Board members last 10 years in office to insulate them from the political cycle, and we can say almost 30 years later, after adoption of independence, that we have succeeded and that inflation expectations in a time horizon of 2 years are consistently pinned down at 3%. So in this picture here, you see how monetary policy has evolved as measured by the monetary policy rate in blue, and the inflation in green over the last over the period in which inflation targeting with a floating exchange rate has been under operation. So it is already 18 years that this regime has been in place. And speaking of the extent to which expectations help to achieve this inflation target, you can see in this picture here how expectations over a 1 year or 2 year horizon have evolved over time. And you can see that for the time frame of monetary policy, which is 2 years, and which is depicted by the red line, you can see that expectations have been pretty consistent around the policy target of 3%. I think the largest difference that we have on the basis of one of these surveys that are applied by the central bank is, I think, 2.6% a few months ago, but now that is back very close to 3%. So that is very much the case of a monetary policy rule. So what about the fiscal policy rules? Fiscal policy rules have a different story. They are much more diverse, both in terms of their formal definition, their implementation, compliance may be less strict. So what can we say about that? The IMF defines a fiscal rule as something that imposes a long-lasting constraint on fiscal policy through numerical limits on budgetary aggregates. So fiscal rules are supposed to generate a constraint that is more permanent and that would limit the ability of authorities to move budgetary aggregates beyond what is in the target. These days, there are a number of countries that have adopted fiscal policy rules. There are a number of different rules depending on the aggregate that is being targeted. You have debt rules that target the limit of, that put a limit on public debt as a percentage of GDP. There are budget balance rules that constrain the overall balance or the structural balance, and we will speak a little about that later. There are expenditure rules that set limits on total primary or current expenditure, usually as a share of GDP or in terms of real changes on an annual basis. There are a number of countries that may have more than one rule in place. So contrary to what happens with monetary policy, there is less consensus on what the right fiscal rule is, and it actually seems to be the case that each country has to adopt the rule that better fits its institutional, political, and economic needs and constraints. So in terms of numbers, these days there are about 80 countries that follow some kind of fiscal rule. Of those, I think about half of these countries have adopted a structural balance rule, including the 27 members of the Eurozone that adopted that back in 2012. So in these graphs, you can see very much how these different set of rules have been adopted by countries. Most of fiscal policy rules are balance rules. A few others are debt rules. Usually they are adopted in combination. In the case of the Eurozone, actually you have both. You have a limit on the government deficit. There is the limit on the debt to GDP ratio, and then there is also a structural balance rule that expects a structural balance to be about 0.5% of GDP. Then you have different classifications depending on the nature of different countries, and also on the extent to which fiscal rules are done at the national level or at the supranational level that includes the Eurozone countries. Fiscal rules can be good for the economy provided they are well defined, they're stable, and that the institutional setup of the country is strong enough to ensure compliance. Adding to our previous discussion about the rules as compared to discretion, there is the fact that political cycles are short and the temptation to overspend when in office is large. So that's a particular feature that is relevant for fiscal rules. In the case of emerging economies, this problem is exacerbated by weak systems of checks and balances and poor accountability. On top of that, emerging economies are usually more vulnerable to external turbulence and therefore need access to international capital, precisely when markets are more reluctant to lend to them. A credible fiscal rule may improve confidence in the economy in addition to putting discipline to the policymaker. So far, there have been only a few studies that provide a thorough assessment on the effectiveness of fiscal rules in practice because most of them have been in place for a short time yet. The few studies that have looked into this matter have found that fiscal rules constrain expenditures and deficits that lead to more sustainable fiscal policies. there is also some evidence showing that the rules limit procyclicality of fiscal policies, like what is reflected in this chart here, where Chile appears at a very with a very small correlation between the cyclical component of real government spending and real GDP. This is for the time when the structural balance rule has been in place in Chile, as compared to previous periods when fiscal policy was very pro-cyclical, as it is usually the case in many emerging countries. As with monetary policy, there is always the concern that rules may limit the ability of policymakers to react through policy to shocks that may hit the economy, especially when these shocks are large and unexpected. This problem is aggravated by the fact that it is usually when these shocks take place that countercyclical fiscal policy becomes a crucial stabilization tool. To deal with this, a number of countries have included some escape clauses in their fiscal policy rules. But again, the question on when and why to call an exception to the rule is a key issue to define. A problem with fiscal rules is that compliance is far from perfect. At the global level, only half of balanced budget rules are complied with. This number seems a little worrying, and the natural question that arises is how this impacts fiscal performance and what can be done to enforce rules more effectively. Even in a traditionally prudent country like Chile, compliance with a fiscal rule may be hard to achieve. The structural balance rule was adopted in 2000 and has been in operation for 18 years already. But after 7 years of very strict compliance at the beginning, 10 years have followed where the public finances have departed from the rule, from the target at different scales. So this is an important issue. And then I raised the question on why is that fiscal policy rules maybe look more difficult to achieve than monetary policy rules. What is behind that? So in order to do that, I think it is useful to deconstruct macro policy rules because they are actually a combination of different features. First of all, a policy rule is based on an underlying indicator that provides the basis for setting up the rule. In the case of monetary policy, this basic indicator may be current inflation, maybe core inflation, maybe future inflation. In the case of fiscal policy, as we saw earlier, the underlying measure could be debt, balance, fiscal balance, or spending. So even though thinking of this aggregate upon which to build a rule suggests that you may want to have something that is very simple to calculate, that is very transparent, sometimes that doesn't make a lot of macroeconomic sense. And then countries move or use more sophisticated measures like future inflation, like inflation expectations, like a structural balance that adjust for the effect of the business cycle on government revenues. When you do that, the issue is that that data does no longer emerge directly from conventional statistics, but they have to be estimated. And then estimation of some of these aggregates then requires a lot of transparency to ensure that that authorities are not manipulating these calculations in order to produce a result. Secondly, a macro rule requires a numerical target. So even if you define, once you have identified an aggregate that you want to follow, then you have to fix a specific target. So in the case of inflation, for instance, in the UK, the inflation target is 2% over the medium term. In the case of Chile, it is 3% over a 24-month scenario. In the case of fiscal rules, you may have a target for debt that is fixed at a sustainable level, let's say 20% of GDP, 30% of GDP. It may be a deficit, like 3%, as it was in the Growth and Stability Pact of the Eurozone. Maybe a structural balance target that doesn't need to be zero. So there are a number of choices. But what is important here is that the combination of measure and target indicates how policy will respond to shocks and changes in the economic environment, whether it's going to be pro-cyclical, neutral, or counter-cyclical. Third, rules also require a regular reporting mechanism to compare the actual value of the indicator vis-à-vis the target. While countries may benefit from establishing a rule, they will only reap its full benefits upon actual compliance, which may in turn determine the credibility of the rule. When you adopt rules that are based on complex indicators, then this reporting mechanism needs to be a little more complex. So, for instance, when you do inflation targeting, it may be necessary to disclose the forecasting model, disclose key assumptions and results all over the structure of this model, not just the result in terms of inflation, not just the guidance on monetary policy, on the path of the policy interest rate, but also on what this model is telling you about unemployment, economic growth, salaries, and so on. In the case of structural budget measures, many countries have created fiscal councils to provide, to create an additional actor that will ensure that the results that you are reporting are correct and are provided on a timely basis. So today, I think that of the 40 or so countries that have adopted the structural rules, probably 80% or so have also created these independent fiscal councils. Fiscal councils are not to fix, to define fiscal policy. They're basically there to ensure that whatever the fiscal policy target is, you can compare that with actual fiscal figures. Fourth, a macro policy rule may need also these escape clauses that I spoke of earlier, allowing to depart from the rule under exceptional circumstances. When departing from target, the authorities should be able to explain the factors that explain the gap or invoke an escape clause. So in the case of monetary policy, for instance, that happens when you have short-term random shocks on more volatile prices, including pass-through from the exchange rate, when you face liquidity shocks that compromise the transmission of monetary policy, like what happened during the global financial crisis in many advanced countries. In the case of fiscal policy, you may invoke escape clauses when you face major demand shocks or when there are constraints to monetary policy that requires more active fiscal policy to ensure a macroeconomic outcome. Fifth, macro policy rules also require accountability mechanisms that establish the rewards and penalties to policymakers when they depart from target. This may run from symbolic or reputational accountability mechanisms where there is no actual penalty on economic terms or in political terms, but the fact that non-compliance is exposed to the public or exposed to markets, that may be powerful enough. In some countries, there are more direct and more compulsory mechanisms, like in the case of New Zealand, where the governor of the central bank may be fined for not achieving the inflation target. And finally, a macro policy rule requires convergence provisions to organize the transition towards the target when you are departing from a distant place, or to return to it when you are missing the target or you resorted to an escape clause. In the case of countries in the Eurozone, for instance, many of them started from when you had a structural target of 0.5% deficit. Many of them started from 3, 4, or 5% of GDP deficit. So you have to chart a path to get there. And when you abandon temporarily the rule, if you want to remain credible, you have to find a way back that can also be checked and verified over time. So I refer to these 6 components of a macro policy rule to provide you an idea of the degree of variance in terms of the way in which you structure these rules, but also because they can help us in understanding why are monetary policy rules more complied with than fiscal rules. So a first set of factors may emerge from specific design issues with these rules. For instance, in the case of government as compared to central banks, if in the case of a central bank you're targeting inflation, where inflation is measured in a very standard way in countries, while government accounting is not so much regulated than private sector accounting or statistical measure like inflation. So in many countries, you see that there are accounting changes that sometimes may explain why you depart from a rule, or that the governments may foster to explain or to correct the course. In the case of Europe, there are countries that are major countries. Sometimes it was Germany. From other advanced countries, Japan sometimes have come up with major changes in their fiscal aggregates because of measurement issues. So the measurement is less standardized with fiscal policy than with monetary policy targets. Secondly, you may have unrealistic or inappropriate targets. You may have pro-cyclical rules. If you have a cap, if your target is a number on the actual budget balance, then it is very likely that in the business cycle, fiscal policy will become pretty pro-cyclical. Because when you are in the lower part of a business cycle, and when government revenue is decreasing, you would be forced to bring expenditure down. And by that, you would be amplifying the business cycle through public finances. So in that case, it would make a lot of macroeconomic sense not to follow that kind of rule. But with that, then compliance would be a compromise. So again, there is a design issue that may be eroding the ability of fiscal rule to operate. Third, you may have information asymmetry. You may have inadequate reporting. As I said, in the case of accounting, governments don't have a very standardized framework, and the same goes for reporting. And finally, you may have poor accountability, including convergence provisions. So on the fiscal side, I would say that if you go through these different components of a policy rule, you may find some important differences with monetary policy that may explain why sometimes it's more difficult to deliver on that. You may also have problems that arise from the political dimension of fiscal policy. First of all, because governments have a number of goals to fulfill. It's not just a fiscal stability or some stance of fiscal policy. You have a number of other goals in terms of policy in different areas, education, health, and so on. And you have many situations in which these different goals clash. You may have time inconsistencies with a preference for short-term employment or activity outcomes, or you may have a weak checks and balances due to biased preferences. So you may have a number of factors that are supposed to generate a set of checks and balances, but if all of them have the same preference towards more expenditure, then of course those checks and balances are very unlikely to operate. And finally, you may have inconsistency between monetary and fiscal rules. Monetary policy and fiscal policy are supposed to operate in combination with each other. Consistency of both is pretty important, but if they're not properly coordinated, you may have many situations in which a fiscal or a monetary policy rule is more difficult to follow because of the evolution of the other component of macro policy. So with this, I think we could close. I think I would say that you may wonder if after all of this, a fiscal policy rule is really worth the effort. It requires a lot of building in terms of institutions, accountability, reporting, and so on. I would say that I think that there are a number of factors that justify a fiscal rule. First of all, because through a fiscal rule, you can effectively speed up the benefits of fiscal discipline. You can bring them forward without needing to build a record, as long as you comply with the rule later. Second, a fiscal rule makes it much easier to operate a monetary policy rule. Third, a fiscal rule helps to reconcile top-down budgeting that matters for macroeconomic purposes with bottom-up operational programming that matters for all the other things that governments do. And finally, when you have well-designed fiscal rules, they can reduce funding uncertainty within government and extend the planning horizon of public policies that are usually necessary to make public policy more effective. So I think that in closing, I would say that that macro policy rules have been a very important innovation in public policy. They have been adopted by many countries around the world. They create an environment for macro policy that is very different from what we saw in the past. And of course, this is not the end of policy making. It is actually setting up a framework within which you can make a number of other decisions without having to go through a number of iterations with monetary policy or fiscal policy to be able to deliver on a number of other issues. In terms of outcomes, at least monetary policy rules, at least inflation targeting regimes have been very effective in bringing inflation down in most countries. In the case of fiscal rules, even when they're not entirely complied with, they provide a benchmark that allow countries to manage, or governments to manage their fiscal policy within certain boundaries. And that creates much more trust in what the policymakers can do. So with that, I can close and we can go to the Q&A in the time that is left. So thank you.
Governor, thank you very much for a masterful presentation there. And I think what's striking for me is really thinking about not only the selection of the target, but actually all the design and institutional setup that's needed to make sure that that's credible and that you build up and then maintain the credibility of the central bank in particular. So I'd love to open up to questions now. Perhaps we should start with questions particularly on this topic of rules and discretion of policymakers, and then perhaps some wider questions about your professional career. I can see a question right at the back there.
Good afternoon. My name is Hector Fuentes from Venezuela. My question is, first, which mechanisms of enforcement are there available in Chile to make the government respect the fiscal rules that you have proposed, like judicial review, or what are the mechanisms of enforcement? And the second question I have is, in Latin America, it's difficult well, not in Latin America, I'm talking from Venezuela, it's difficult to think of a long-standing independent authority. We had those lights, those flashes in the past, but they don't last. And I think the experience of Chile is being very productive and good for the rest of the region. So I wanted to ask you, which are those things in the Chilean system that has allowed this independent central bank to last for so long?
Okay, great. So if you'd like to come back on those two questions.
Okay, well, on the enforcement, I would say that in Chile it is essentially the main enforcement mechanism is essentially the political prestige of government. There are no provisions for judicial review. Eventually, Congress may take some action if they saw the government departing substantially from its policy target, but that has not happened yet. So, but transparency makes a very important difference, and the degree of political commitment is very important as well. When this structural balance rule was adopted in 2000, we thought a lot about whether we should issue legislation on the subject, or whether this could be written into the Constitution. And our conclusion was that at the time we started drafting legislation on this, we would have to think of a number of exceptions. And actually, the only way of making this rule credible was not through what was written into the law, but actually by delivering on these commitments. Now, I mentioned that more recently there have been difficulties in delivering on the structural balance target. So what is currently discussed in Chile, and I think it's a definition of the new government, is to create a fiscal council that is fully independent. Again, in the definition of a fiscal council as essentially a body that ensures that secures that the information that is provided on the actual results of fiscal policy are fully transparent and verifiable. Now, on independence, the independence of the central bank was a very important innovation in the late 90s, in the late 80s. It was written into the 1980 Constitution that was, of course, issued during the dictatorship. In 89, it was still the time of the Pinochet regime, but it came up at the time of a transition towards a democratic rule. So there was a lot of negotiation at the time to secure that independence could be secured over time, and that the board of the central bank was balanced enough in terms of political sensibilities to ensure that it would have the legitimacy to carry forward under a completely different and definitely more open regime. So I think that over the years there has been a lot of care both within the central bank and outside the central bank to protect this independent status. And today is something that is not challenged in the country because the central bank has built a record by itself. Now, being governor of the central bank, I would say that the main challenge that I have in this sense is to ensure that the central bank is focused on its specific target. If we use the power of the central bank to try to do something else, either influencing a public discussion on a number of other issues, I would say that probably the independence of the central bank would be compromised. Sometimes I have compared this balance with the role of a goalkeeper in a football team. You know, a goalkeeper has a number of powers that other players don't have. but he has to use that for a specific purpose, which is protect the team from from receiving a goal. So I think this alignment between independence and focus in terms of specific targets and being accountable for that, I think that is the key for any independent institution, and is the one that helps this sort of arrangement within a democratic regime. Because if you created an independent body that has a lot of powers over a number of dimensions of public policy, of course that would clash with democratic role very, very easily.
Yeah, I can see more people with hands up. I'm going to take a couple more questions, and I have a couple myself. Yeah. There's a gentleman back there.
Hi, I'm Ricardo from Chile. In terms of bringing discipline to the policymaker, as you said, politicians, and you as being one of the designers of the fiscal rule, could you tell us how was the political and technical bargaining or process at the time that was created, and what are the takeaways from the last 10 years?
Great, thank you. And I think there's a good question as well. Let's take that one as well. A couple more. Yeah, gentleman at the, Felipe, did you have a question? No.
Yes, I'm Luis, also from Chile. So very, very brief question. So you focus mainly on single mandate monetary policy rule. But the US is a prime example of a dual mandate, which is both in inflation and unemployment.
Sorry, just so we can all hear. This is the dual mandate.
Dual mandate. Yeah,
inflation, targeting,
unemployment.
and also unemployment.
So the question is, do you see some reason why the single mandate is perhaps superior to the dual mandate, which I think is just more broad? The single mandate is just more broad around the world.
Great, thank you. And I'm conscious of time, so I want to see if there's any other questions at this point to put on the table. Yeah, let's take one more question from. Yeah, we've got.
Hi, I'm Juliana. I'm student of doing public policy here at the Blavatnik, and I'm Brazilian. And we have recently election in Chile, and the government that's shifting is from Michelle Bachelet, which is a concertation of parties from the center and the left, to a so-called fairly right government, which is Sebastián Piñera's. And although we've been discussing about the independence of central banks, and I think this is a main issue in our continent, I would actually like to know from you if you think that there is an impact from this shift in government and how.
Great, thank you. So 3 meaty questions for you there, Governor.
Okay, so the first question had to do with how to gain legitimacy, essentially how that happened, especially with the fiscal rule, right? So I think that the introduction of the fiscal rule in Chile was a very interesting experience. I mean, first of all, prior to that, structural balance rules didn't exist. I mean, we created that on our own. In parallel, Sweden was adopting a structural balance rule, but we were not aware of that, and Switzerland was doing a similar effort. But all that happened in parallel. So we had, first of all, we had to invest a lot of effort in explaining. We produced a very detailed paper on the rationale of that, on the why structural balance made sense in terms of measuring fiscal policy. And then we invested a lot in terms of explaining the rule to the public and to members of parliament.
And just briefly on that, what was the genesis? Why be the front runner? What was the sort of compelling? Yeah,
well, essentially that came from the late 90s, in the wake of the Asian crisis, in the Asian economic crisis. There was a lot of discussion on the kind of advice that the IMF was giving to Southeast Asian countries, and there was a lot of criticism of that. And at that time, Nicolás Izaguirre, that became Minister of Finance, he wanted, when he was appointed as a minister, he wanted a fiscal rule that would ensure that we would never get into that kind of situation. Then I myself, I had been working on structural budgets for my graduate studies, and that matched very well with what he was looking for, because the structural balance, the main advantage that it has is that it allows automatic stabilizers of the budget to operate. So I think that much was key in terms of building the rule and then securing political support in the country, because people that feared the government expanding too much on the basis of growing revenues, they thought that structural balance rule would prevent that to a certain extent, and those that feared the effect of a crisis on public revenues and on public expenditure, they value this approach as well.
Dual mandate. Yeah, so why not think about unemployment? Why be obsessed with inflation?
Yeah,
well, sort of strong way of putting that.
Yeah, well, it is not only the US that has that mandate. Australia, I think, has also economic stability, and I think it's the well-being of the Australian people, something like that. Now, especially in combining with unemployment or economic activity, I think that that the dual mandate doesn't make a lot of difference, because usually output gaps and unemployment gaps are very much aligned with gaps in inflation. Usually when you have a high unemployment or low growth at the same time, probably you are facing low inflation as well. So I would say that, I don't know, 80% of the time, when you're trying to achieve your inflation target, probably you will be helping to reduce the gap in unemployment and economic activity as well. Now, given that in addition to that, you have some room for maneuver in the shorter run with monetary policy, very much like I showed there with data on the exchange rate. To the extent that that monetary policymakers can choose the path towards the inflation target within this 2-year period, then I think you are able to deal with some trade-offs that you may be facing between these two targets, these two goals. So actually, if you look at the Federal Reserve or the Reserve Bank of Australia, how they conduct their monetary policy, you cannot identify a big difference with other countries that have more of a single mandate. Finally, central
political
bank.
shift. So this is the current political shift in Chile.
Yeah, well, there was a political shift, and I'm still there as governor of the central bank.
Yes.
Yeah, I have a 5-year mandate. I mean, I was appointed as member of the board for a 10-year term, as all the other members of the board, and that is proposed by the president and endorsed by the has to be endorsed by the Senate majority. And of the 5 members of the board, the president chooses the chairman of the board for a 5-year term. So I was appointed as a member of the board in 2015, and then in 2016 I became chairman of the board of governors. And people serve their terms in full. That has happened in the last almost 30 years since central bank independence. There have never been pressures for people to resign or something, and we don't feel in any sort of need or pressure to do that. And because I think that the central bank, we all see the central bank as an institution that is serving the country, and that by keeping inflation stable, it would be helpful with any other components of public policy. So yeah, you have to earn some prestige there. You have to ensure that that these rules are complied with, the rules on appointing central bank governors and board members. But once you build the record over time, it is much easier to ensure that it can operate throughout the political cycle.
And be insulated from the politics, which I think is sort of back to that very first question about the conditions under which you sort of can get that independence. Now, looking at your schedule, I know you're on a train out of here in an hour, having had lunch. So I don't know if is there any last pressing question? Otherwise, I'm going to turn to the governor for a sort of wrap-up comment, which I don't see a burning hand. But perhaps a wrap-up comment and just thinking about, for all of us in the room, as sort of aspiring public policy practitioners or professors of public policy, there's sort of perhaps the one lesson that comes to you from all of this experience about rules and discretion, and actually ensuring that rules and regulations are in the public interest. So sort of one pearl of wisdom that you might want to leave us with. Yeah,
well, what I would say is that usually people think of policy rules as something that is tying the hands of government. And in tying the hands of government, that may be preventing government from responding to political mandates. In my view, in variables like this, the budget balance and inflation, I don't think that it is very easy that you will get a political mandate to raise inflation or things like that. Basically, what you need is a stable environment within which you can deliver on a number of other commitments of government. So, I mean, my experience with fiscal policy, for instance, is that to the extent that you have a well-designed fiscal rule, that would give you much more room for designing good education, health, retirement policies, because that would broaden your planning horizon. The same goes for inflation. If you have a high or volatile inflation, many of the things that you want to do in government policy maybe just vanish in the air because you created some kind of subsidy or some kind of economic support for people, but the purchasing power of that may be eroded very rapidly. So rules are not for everything. I think that you should think of rules as something that creates an enabling environment for many other components of public policy.
Great, thank you very much. The sort of enabling power of sort of rules on these really big, important, fundamental macroeconomic aspects of the economy. So please join me in thanking the Governor. We're so grateful to you for taking time out of your very busy schedule to be with us. It's an absolute privilege and a pleasure for all of us to have you here. So thank you very much.